For years, Tesla has been, pretty much synonymous with innovation. I mean, this is a company that hasn't just made cars, right? It's fundamentally reshaped an entire industry. They really pushed electric vehicles into the mainstream, pushed the boundaries with battery tech, and even dared to dream about full self-driving years before almost anyone else took it seriously. But what happens when that road, usually so smooth, so forward-looking for Tesla, gets a little bumpy, maybe even riddled with potholes? Today, we're taking a deep dive into the recent twists and turns on Tesla's journey. We'll be exploring their latest financial results, yeah, the numbers, but also the incredibly ambitious bets they're making on the future. And importantly, the shifting policy landscape it's adding new layers of complexity to their path forward. Our mission, like always, is to pull out the most important nuggets of knowledge from the recent reports, from those candid conference calls, and from sharp analyst insights. We want you to really understand what's driving this electric vehicle giant and, where it might be headed next.
We've certainly gathered a compelling stack of information for this deep dive. Our sources include direct quotes from Elon Musk himself from those recent quarterly results calls. We've got the nitty-gritty details from their quarterly financial reports, the stuff that really lays bare the company's performance, plus incisive analyst notes from firms like TD Cowen, which give you that external perspective, and, of course, comprehensive reporting on government policies and regulatory oversight, which are definitely shaping Tesla's immediate future in significant ways.
Absolutely. So whether you're someone deeply interested in the future of transportation, or maybe curious about the intricate impact of government policy on an industry leader, or maybe you're just fascinated by what's next for one of the world's most talked about, most disruptive companies, well, this deep dive is definitely for you. We're going to try and cut through all the noise, get straight to the core of what's really happening inside and around Tesla right now. Let's get into it. Okay, let's unpack this then. We really have to start with the stark reality of Tesla's recent performance, because the numbers themselves, well, they're quite jarring. The company just posted its worst quarterly sales decline in over a decade. Now, that's not just a statistic, is it? That's a pretty significant statement for a company that has been on such an aggressive, almost relentless growth path for so long. It immediately flags that something fundamental has shifted, or, at least encountered a major roadblock for a company defined by rapid expansion.
Indeed, the numbers are. Well, they're more than just challenging. They paint a picture of a substantial downturn. The company's profit, it fell notably short of Wall Street targets. That's a key metric for investor confidence, obviously. The reports from April showed revenue falling by 9%, and even more strikingly, net income just plummeted, an astonishing 71%.
71%.
Wow. Yeah. This wasn't just a slight miss, it was a substantial blow to their bottom line, really. And to put this into a bit more context, this comes after Tesla had already reported its first ever decline in annual vehicle sales back in January. And even then, their profit margins were already below estimates, which kind of set a challenging tone for the whole year. But amidst all these grim figures, there was one single bright spot, you could say.
Okay.
The profit margin on actually making the cars, while still a concern, was actually better than many feared.
Okay. That distinction is crucial, isn't it? So it's not necessarily a problem with their fundamental production capabilities or the cost structure of manufacturing itself, but rather maybe a hurdle in getting those cars into customers' hands profitably in the current market.
Exactly. It hints at things like pricing pressure, maybe slowing demand, rather than, say, a major internal operational failure.
Right. So if their ability to build cars is still relatively strong, but sales are slumping, what does that tell us? And speaking of candid admissions, Elon Musk himself addressed this pretty head-on during that quarterly results conference call. He directly admitted that the company could have a few rough quarters. That's a pretty striking statement, almost unsettling for a CEO known for his ambitious, often wildly optimistic projections. It's a rare moment of public vulnerability, maybe.
It truly is a rare concession, and he didn't just hint at it, did he? He cited a specific time frame for this potential turbulence. Musk stated that these rough quarters could extend from the fourth quarter of this year right through the first half of next year. So that's Q4, Q1, and he even said maybe Q2.
Okay, so quite a specific window.
A very specific and concerning window of anticipated difficulty. Highly unusual for a company like Tesla that typically focuses on exponential growth.
Right.
And the market reaction, it was immediate. and telling. Tesla shares fell nearly 5% right after his comments were made public during the call, and they actually continued to extend their after-hours dip, ultimately down almost 5%, or maybe 4.4% by the time the call actually ended.
Wow.
Yeah. So this kind of direct, unvarnished admission from the CEO, coupled with that immediate negative market response, it really underscores the seriousness of the financial headwinds Tesla is anticipating. It signals that even the most optimistic leadership recognizes a period of significant recalibration is needed, and investors clearly took that very seriously.
Okay, so if Musk himself is warning of rough quarters ahead and the market's reacting so sharply, what is the core driver behind these anticipated challenges? Is it just a general economic slowdown hitting all luxury goods, or is there something more specific to Tesla or the broader EV market itself?
That's an excellent question, and it's where those external factors really come into play, because while their margins on making the cars are holding up, like we said, the market itself does seem to be softening for electric vehicles, yeah. But Tesla is particularly exposed to a very specific policy change. The primary reason that's been pinpointed for these anticipated rough quarters is the expiration of those $7,500 consumer EV purchasing credits.
The federal tax credits.
Exactly. And they're set to end in September. Now, this isn't just some minor incentive, right? It's potentially a massive financial hit for Tesla and its consumers. We're talking billions of dollars of revenue that Tesla has historically gained, not just from direct consumer purchases being maybe a bit cheaper, but also from something called regulatory credits.
Right, the ZEV credits and things like that.
Precisely. To be clear, these aren't the consumer incentives. This is a system where companies like Tesla, because they sell so many zero-emission vehicles, they accumulate these credits. Then they can sell those credits to traditional automakers who haven't met their own emissions targets in certain states, most notably California's ZEV program.
And that's been quite a revenue stream for them, hasn't it?
A quiet but significant part of Tesla's profitability for years. Sometimes it literally made the difference between showing a loss or a profit for a quarter.
Okay.
So losing them isn't just a revenue dip, it's a structural shift in their business model. This high-margin revenue stream is, well, it's basically disappearing due to new U.S. government policies. And it's not happening in a vacuum either. This is compounded by a broader, stalling U.S. market for electric vehicles. You've got factors like higher interest rates making financing more expensive, plus increased competition from legacy automakers and new EV startups.
Right. More choice out there now.
Exactly. So this combination of factors creates this kind of powerful double challenge for the company. It paints a truly challenging picture for their immediate future.
And these policy shifts, they aren't just about inspiring credits, are they? There seems to be a broader political and regulatory landscape at play that's kind of tightening around Tesla. Let's talk about former President Donald Trump's recently signed Big Beautiful Bill. That name aside, this legislation seems to have direct, substantial consequences for Tesla and maybe the wider renewable energy sector. What exactly is this bill doing, and why is it hitting Tesla so hard?
You're right. It's definitely a multifaceted challenge. This Big Beautiful Bill, as it's been called, it specifically cuts federal tax credits for EV purchases, yes, but it also impacts other incentives related to renewable energy more broadly. So this is a direct financial disincentive for consumers looking to buy an EV. It increases the upfront cost, especially for a premium vehicle like a Tesla.
Makes sense.
Yep. And Musk himself, he assessed that the loss of these incentives could impact Tesla precisely while the company is trying to push forward with its, long-promised fleet of autonomous taxis. He described it as being in a weird transition period where we'll lose a lot of incentives in the U.S.
A weird transition period. Right?
Yeah, and this is a critical point because Tesla's valuation and its future growth strategy are increasingly tied to these futuristic technologies like autonomous driving. And suddenly, a significant chunk of that traditional EV market support, the very support that helped grow the market they now dominate, is being pulled away. So this means they're not just potentially losing sales momentum on the cars themselves, they're facing a higher cost burden on consumers at the exact time they need maximum adoption to fund these next-gen projects. It's almost like, the government is pulling the ladder away just as they're trying to climb up to the next floor.
And it doesn't stop there, does it? Beyond the direct financial incentives, there's this wider net of regulatory oversight being cast, seemingly across all of Musk's ventures, not just Tesla itself. Trump's July 1st call for a review of subsidies awarded to all Musk's companies is particularly noteworthy. That sounds like it could be a significant headache, encompassing way more than just the automotive side.
Yeah, what's fascinating here is how quickly the scope seemed to expand beyond just EV subsidies. This call for such a broad review, it definitely sparks genuine feels of tougher regulatory scrutiny across the billionaires' ventures in the transportation, energy, and space sectors.
So SpaceX, Neuralink, everything.
Potentially, yes. It's not just about Tesla's vehicles anymore. It signals that the political environment might be becoming increasingly wary of the sheer scale and influence of these companies. This could potentially impact everything from SpaceX's spectrum use, their launch operations, maybe even Neuralink-sensitive human trials for brain implants. This kind of broad brush approach raises the possibility of more stringent oversight, potential challenges to their operations. It could even impact their ability to raise capital or stick to their timelines for new product launches across the entire ecosystem of Musk's businesses.
Right.
It just creates a significant layer of uncertainty for an entrepreneur whose companies often operate right at the cutting edge, where, frankly, the regulatory frameworks are still playing catch-up.
That's a huge burden, adding layers of complexity well beyond just selling cars. And speaking of cars, a persistent cloud over Tesla has been the ongoing oversight from U.S. auto safety investigators, particularly concerning the safety of its vehicles when using those advanced driver assistance systems. What's the latest on that front? What are the implications?
Yes, this has been a consistent point of, well, contention and investigation. It adds yet another layer of regulatory pressure. For example, the National Highway Traffic Safety Administration, NHTSA, they've been actively investigating Tesla's full self-driving collisions, especially those occurring in reduced roadway visibility conditions. That investigation has been going on since October.
And we should remember, full self-driving, FSD, still technically level 2, right? Needs supervision.
Absolutely. It requires active human supervision. It's not truly autonomous in the way a fully driverless robotaxi is meant to be. So NHTSA's investigations are looking into incidents where the system's performance, particularly in challenging conditions, might have contributed to collisions, even with a human driver supposedly attentive. And more recently, NHTSA requested more information after reviewing some online videos that popped up. One reportedly showed a robotaxi using the wrong lane. Another showed a driverless vehicle apparently speeding.
Oof, not great timing.
No, especially since this request came shortly after Tesla had actually launched that limited paid robotaxi test service down in Austin. It just highlights the immediate scrutiny on any new deployment. And if we try to connect this to the bigger picture, well, it raises an important question, doesn't it, about the regulatory environment maybe shifting as quickly as the technology itself.
Or maybe not shifting as quickly.
Or not shifting as quickly, exactly. The pace of innovation, particularly in these autonomous systems, seems to be outstripping the established regulatory frameworks. This leads to a more reactive rather than proactive approach to oversight. So while Tesla is probably in a relatively solid position financially to withstand any direct barrage of mercurial tariffs from the previous administration, the company will undeniably suffer from these other policies that specifically slash support for electric vehicles, especially in an already stalling U.S. market.
Right.
It's kind of a pincer movement. Direct financial disincentives combined with heightened safety scrutiny. It creates a very challenging operational landscape for a company that thrives on pushing boundaries.
Yeah, it really paints a picture of a company navigating not just technological hurdles, but a pretty significant shift in political winds that could impact its core business. But okay, despite these immediate financial challenges and regulatory pressures, Tesla is still pushing this grand long-term vision. This involves not just pursuing autonomous driving for privately owned cars, but also this ambitious fleet of dedicated robotaxis. It really feels like they're betting the farm on these future technologies.
That's absolutely right. The vision remains incredibly bold. You could even say audacious, especially given the current headwinds that would make most companies maybe pull back a bit. Tesla is planning for dedicated robotaxis, purpose-built from the ground up, supposedly entering production next year.
Next year,
Yeah.
already.
That's the plan. And then the even more futuristic, custom-built robotaxi called the Cybercab and the semi-truck are slated for 2026. Now, this isn't just an iteration on their existing car models, right? These are entirely new vehicle platforms designed specifically for autonomous purposes. It signals a complete reorientation of what Tesla sees itself becoming, moving far beyond just selling cars to individuals, towards a future where they could potentially own and operate vast fleets of autonomous vehicles themselves.
Like a service company almost.
Exactly. The scale of this plan, from dedicated production lines to a whole new service model redefining urban mobility, logistics, it's immense. It requires colossal investment and, frankly, flawless execution. It's truly a high-stakes bet on fundamentally reshaping transportation as we know it.
Okay, here's where it gets really interesting, though. Despite all the talk, all the future promises, Tesla actually did deploy a small group of self-driving taxis picking up paying passengers.
Yeah.
On June 22nd in Austin, Texas. This isn't just a concept anymore, is it? It's real people, paying customers, in cars without human drivers. That feels like a significant step.
It was a genuinely significant event, yeah.
Yep.
It marked a tangible transition from vision to reality, however small that reality is right now. It really marked the first time Tesla cars without human drivers have carried paying riders. That's a major milestone for any autonomous vehicle company.
Huge.
Now, it was a relatively small trial, okay? Involved about a dozen Model Y SUVs initially, so we're not talking about a widespread launch just yet. But it's a concrete first step, an actualization of a long-held promise. You'll probably recall Musk had earlier promised a Robotaxi service in Austin specifically for June.
Right, he called that shot.
He did. And they hit that self-imposed deadline, albeit with a limited rollout. What this demonstrates is a capacity to deliver, even if it's on a small scale, on these incredibly ambitious timelines. That's something that has often been, debated regarding Tesla's promises. It's a critical bridge between the theoretical and the practical. It shows their technology in a live commercial setting. That's a different beast entirely from internal testing or even limited public trials. It's the first time the public, beyond employees, has really experienced it as a paid service.
And this brings us straight to the elephant in the room. The company's valuation. Much of Tesla's incredible, trillion-dollar valuation arguably hangs on this very bet, its Robotaxi service. And increasingly maybe on its development of humanoid robots too. It feels like it's not really about how many Model 3s they sell next quarter anymore, is it? It's about this massive vision of the future.
Precisely. The market is valuing Tesla not primarily as a traditional automaker anymore, but fundamentally as a future-facing technology and AI company. And this is where the tension really arises. Analysts at TD Cowen, they really brought this into focus recently. Following a recent conference call, they remarked on an elevated level of boastful claims regarding Tesla's future. Pretty blunt.
Boastful claims.
Yeah. They went on to note that more than 75% of the call focused on facets of the business that don't exist and have been discussed for several years now. Ouch. That highlights a significant disconnect, doesn't it, between what the company is currently delivering and what it's asking investors to believe in for its future valuation. It's almost as if the company is saying, don't look at the rearview mirror, just keep looking way out at the distant horizon.
Yeah.
But despite this skepticism, Musk himself remains remarkably optimistic. He stated that once you get autonomy at scale in the second half of next year, certainly by the end of next year, then Tesla's business would be very compelling.
Yeah.
It's classic Musk, right? Doubling down on the future, even when the present looks challenging. But the analyst critique points to a fundamental question. How long can a company's valuation be sustained primarily on promises, even groundbreaking ones, rather than tangible, scaled-up revenue from those new ventures? What's fascinating here is just how heavily the narrative around Tesla is weighted towards these future, still unproven technologies, even while their core automotive business faces such immediate challenges.
That's a truly fascinating point. So despite reshaping the car industry in such profound ways, it almost sounds like Tesla is becoming even less of an automaker, at least for investment purposes. It's like a complete transformation of its perceived identity.
That seems to be the emerging reality, yeah. And those uninspiring second quarter results, they only reinforce this idea. It suggests that Musk will probably keep driving this trillion-dollar company towards self-driving taxis, humanoid robots, energy storage. These are clearly the areas where he sees the exponential growth, the disruption potential. The implication is, maybe, that with electric vehicle sales slipping and only, as some critics put it, half-baked promises of an affordable car on offer, Tesla's benchmark status as the undisputed leader in automotive innovation might actually fade further in the rearview mirror. Investors are increasingly being asked to buy into a vision of a future that's still quite nebulous, rather than the concrete quarter-over-quarter performance of their existing industry-leading product lines. This isn't just a pivot. It feels like a fundamental redefinition of the company's core identity. And that brings a unique set of risks. And potential rewards, of course. It shifts the whole investment thesis, doesn't it? From a manufacturing and sales story to maybe more of a pure technology and AI speculation story.
And while all this future-gazing and robo-taxi talk is happening, what about the more immediate, tangible products, the ones many everyday consumers are actually waiting for? Let's turn to another key area, that much-anticipated new, cheaper car. Now, Tesla's working on it, right? They produced some initial units by the end of June, but the chief financial officer, Vaibhav Taneja, stated that production would ramp up next quarter, slower than initially expected. That phrase, slower than initially expected, it seems to be a common thread lately, doesn't it?
It definitely is a recurring theme, and it's a critical one for their immediate market position. This delay in the ramp-up of the cheaper car is highly significant because it impacts their ability to capture a broader market segment, drive volume, especially now as other automakers are really flooding the market with more affordable EV options.
Yeah, competition's heating up there.
Absolutely. Companies like China's BYD are aggressively expanding their reach with competitive, lower-cost electric vehicles globally, and traditional automakers are also introducing more budget-friendly EV models. So every delay potentially means lost market share, missed opportunities in this rapidly evolving landscape. And the company, very tellingly, did not provide an update on its full-year deliveries forecast.
Oh, interesting.
Yeah. They cited the economy and specifically the timing of this new car rollout as the reasons for withholding that guidance. That suggests pretty deep uncertainty about their sales trajectory for the rest of the year. And this feeds directly into that critique we mentioned that Tesla is currently offering only half-baked promises of an affordable car. It's not a fully fleshed out mass market product that can immediately impact sales figures and shore up their automotive revenues right now. So this delay, it just exacerbates the challenges they're facing with expiring incentives and a slowing EV market. A competitively priced new model could have been a significant counterbalance to these headwinds. Instead, it appears to be another promise that's taking longer to materialize than anticipated, leaving a kind of strategic gap in their current product strategy.
So it's not just the cheaper car facing delays or struggles then. Let's broaden the view a bit to other segments of Tesla's production. Are there other areas where progress seems to have stalled, or maybe expectations aren't being met, perhaps indicating broader operational challenges?
Unfortunately, yes. The challenges do seem to extend beyond just the new affordable model, possibly indicating a more systemic set of issues. We've seen reports that progress on cutting costs per vehicle sold has stalled.
Ah, that's important for margins.
Crucial for profitability, especially in a competitive market where margins are constantly under pressure. It suggests maybe the efficiency gains they achieved in the past through things like gigafactories might be harder to replicate now, or perhaps they've hit a plateau. Additionally, the word is that chances of a Model Y update revival look slimmer. That suggests one of their most popular current models isn't getting the refresh or attention that might be needed to keep demand really robust against newer competitors.
Okay.
And perhaps most notably, there seems to be a growing consensus that the Cybertruck has peaked.
Peak already.
That's the assessment from some analysts. This vehicle, which generated so much buzz, so much excitement, particularly with its unique design and all those early pre-orders, it seems to have already reached its maximum impact, implying that its contribution to overall sales and revenue might be limited or even declining moving forward, maybe due to its niche appeal, production complexities, or that initial high price point. So the synthesis, it raises serious questions about the execution of their current product lines. While the company is pushing so aggressively for these revolutionary new ones, it's like trying to build a skyscraper while the foundations of your existing buildings are showing some cracks.
So what does this all mean for, the everyday consumer looking for that next Tesla? Or maybe for an investor looking purely at their core automotive business?
Yeah.
It sounds like the immediate future for their existing product lines is maybe a bit less clear, a bit less stable than it once was, especially with this aggressive pivot towards robotaxis. And all these operational and strategic shifts, from the financial headwinds to the ambitious future bets and the current production pains, it inevitably draws attention back to the very top. The shareholder dynamics and the governance concerns that have kind of long swirled around Tesla. The annual shareholder meeting, now set for November 6th. That was quite a saga itself, wasn't it? It wasn't just a simple scheduling announcement.
Oh, it absolutely was a saga, and a revealing one, too. The announcement of that November 6th date actually came just a day after a group of 27 investors publicly urged the automaker to set a date. They were citing specific legal obligations under Texas law.
Okay, so they were pressured into it.
It appears so. This pressure arose because the company had actually missed a deadline under Texas law. The law explicitly allows investors to seek legal...
Okay, so while the immediate threat of legal action might be rare, what's the core issue here, really? Is it just about setting a date for a meeting, or is it symptomatic of a larger problem with how the board engages with its shareholders?
Well, according to Kevin Thomas, who's the CEO of that's a prominent shareholder advocacy and advisory organization, he says the core issue isn't merely the amount of time shareholders have to file a resolution. He emphasizes that, quote, The Tesla board's efforts to dismiss shareholder proposals is a bigger impediment than having a very short window to submit them in the first place.
Ah, okay. So it's about how they handle the proposals themselves.
Exactly. This speaks to a more fundamental disruption of what should be a normally predictable and legally clear filing process for shareholders. It's about the board's posture towards shareholder input, their perceived willingness to engage seriously with proposals. If shareholders feel their voices are being actively suppressed or that their proposals are being dismissed without proper consideration or a fair hearing, well, it deeply erodes trust, and that can impact investor confidence in the long term. It suggests maybe a pattern of behavior where the company might be perceived as less responsive to its ownership base, perhaps prioritizing its own strategic direction over robust shareholder dialogue and oversight.
Right.
This definitely raises an important question about corporate governance and the balance of power within a company as influential and, frankly, as scrutinized as Tesla.
And this dynamic, it seems to play out in their conference calls as well, doesn't it? The types of questions analysts are asking, or maybe more tellingly not asking, during these critical financial updates. It seems to reflect a certain prioritization, almost a selective focus, from those querying the company.
It certainly does seem that way, and it's a fascinating pattern to observe. For instance, back in April, right after Tesla announced those significant drops, revenue down 9%, net income down that staggering 71%, there was apparently just one question about how rumors of brand damage affected demand.
Just one, after numbers like
It's
that.
just one. Think about that for a moment. Such substantial financial misses, and only one analyst query focused on the direct market impact or potential reputational issues that might be driving those declines. Now, contrast that with the January call. That's when Tesla reported its first ever decline in annual vehicle sales and posted profit margins below estimates. Yet on that call, there were no questions about performance that quarter and only one on the impact of Trump's anti-EV policies.
So what were they asking about?
Instead, analysts largely focused on Musk's autonomous driving plans, his promise of a robotaxi service in Austin in June, the signature stuff. This highlights a particular dynamic, doesn't it, in how questions are framed and answered, often steering away from immediate financial performance and toward those long-term visionary projects.
Yeah, it's noticeable.
And it raises an important question about how communication from the company interacts with investor and public perception, and ultimately, what kind of questions get prioritized. Are analysts in the market perhaps too easily swayed by the next big thing narrative? Or maybe even, you could argue, complicit in a certain kind of narrative control, rather than rigorously scrutinizing the fundamentals of the current business. It implies a kind of selective focus that can sometimes obscure immediate operational challenges in favor of those future promises, which, can be a double-edged sword for investors.
We've certainly taken a deep dive into Tesla's rocky road today, haven't we? It's pretty clear we're witnessing a company in a fascinating, albeit, as Musk put it, weird transition period. They're grappling with immediate financial headwinds. Yep, largely driven by significant policy shifts, stripping away key incentives, making EVs more expensive. They're facing intense and broadening regulatory scrutiny, not just for autos, but across other ventures like SpaceX and Neuralink. And, let's not forget, navigating production challenges and delays for both existing models and that much-anticipated cheaper car.
Yet, simultaneously, despite all these immediate pressures, despite the skepticism from some analysts, Tesla is pouring significant resources into these incredibly ambitious, high-stakes bets on robotaxis and AI. These are the ventures that seem to underpin much of their current trillion-dollar valuation. It's a company that is clearly no longer just an automaker in the traditional sense. It's a bet on autonomy, on artificial intelligence, on energy storage. A massive portion of its market cap is hanging on promises that are still very much in their early stages of development and deployment, with, frankly, little current revenue to show for them yet.
It's a truly complex picture, isn't it? A paradox of present struggles against these huge future aspirations. So as Tesla braces for what Musk himself called a few rough quarters, and as it continues to redefine what it even means to be a car company in the 21st century, what does this all mean for the future of transportation, technology, and investing? How much of the company's long-term success will ultimately depend on its ability to turn these incredibly ambitious visions, from vast robotaxi networks to humanoid robots, into actual mass-market realities?
And how will they navigate that, especially in this increasingly scrutinized, politically charged environment where the very incentives that helped build the EV market are now being pulled away?
It really leaves you wondering, doesn't it? Are these rough quarters just a temporary dip in the road? Just a normal part of hyper-growth companies facing new, tough challenges?
Yeah.
Or are they maybe a sign of a more fundamental shift in the very foundations of the company, signaling a much larger, maybe uncertain transformation ahead for this electric vehicle giant.